30% down in 48 hours. Silver was printing $122 on Thursday. Today it's trading around $85. And in the next 72 hours, you are going to make one decision that will separate the winners from the wiped out spectators. This isn't a normal pullback. This is a forced liquidation event. Margin pressure, headline traps, and algorithmic selling stacked on top of each other. If you do what most people do over the next 3 days, you will hand your position to the same institutions that engineered the shakeout. Quick intro. This is your no-noise silver briefing. No hype, just the playbook. Here's exactly what happened, in plain language. The exchange hiked margin requirements aggressively, nearly 50%, which instantly raised the cash to stay in the game for futures traders. Anyone who couldn't post the extra collateral got liquidated by the system. Then a major policy headline hit. Algorithms read it as hawkish. The dollar popped, metals dumped. And just to make sure the panic had fuel, a widely circulated report implied the US was backing away from support for strategic metals. It was later disputed, but by then the damage was done. The computers had already sold, the margin calls had already hit, and the paper price got punched in the face. Now the weekend is here. 72 hours with no real trading for most people. 72 hours where news can pile up. 72 hours where your emotions have room to whisper terrible ideas in your ear. And that's why this exists. Not to hype you, not to predict Monday, but to tell you what not to do in the next 72 hours. Because the wrong move is the one that feels most comforting in the moment. Before we get tactical, you need one mental reframe. Screen price is not the whole market. It's the loudest market. It's the market that's easiest to hit with leverage, headlines, and liquidity games. Physical reality is quieter. Premiums, inventory, delivery flows, Asian demand. And it moves on a different clock. When paper gets smashed, the public sees crash. Institutions see clearance sale. The question is, are you going to behave like the public or like the buyer? Okay, 5 mistakes. 5 ways people destroy themselves during a shock move like this. Mistake number 1, the weekend panic sell. If you own physical silver, you can't even dump it properly on a weekend. You can stress sell in your head, you can rage sell to a dealer on Monday morning, you can hit market sell on a paper proxy. But if you dump because you're scared, you are doing the oldest trick in this game, selling into forced weakness. Think about the mechanics. The drop you just watched was not primarily investors changing their mind. It was liquidations. People were removed from positions because rules changed or collateral got tight. That is the definition of non-fundamental selling. And non-fundamental selling creates artificial lows. If you sell on Monday because Friday scared you, you are volunteering to provide liquidity to the people who actually understand why the selling happened. And yes, the big players are buying. Not because they are nice, because they can read positioning, because they can see when the market is being emptied out by margin, because they understand that the most profitable buys in commodities often happen when the public is nauseous. Ask yourself a brutal question. Who do you think has better information? The retail crowd doom-scrolling headlines all weekend, or institutions that literally pay teams to track positioning, vault flows, and cross-market signals in real time? If you must reduce risk, that's a different conversation. But "I'm scared so I'm out" is not risk management. It's emotional surrender. Mistake number 2, going all in because the price looks cheap. This one is the mirror image of panic selling. Some people see $122 to $85 and their brain lights up. Discount. They empty the clip. They deploy every dollar, every ounce of buying power, every last bit of dry powder, because they want to feel smart. Here's the problem. A liquidation cascade can overshoot. Support can break. Volatility can expand. And even if your long-term thesis is right, the market can punish your timing so badly that you sell in frustration before the thesis ever pays you. You don't win this game by being right. You win by staying solvent long enough for being right to matter. So if you're tempted to buy aggressively right now, ask a better question. What is my plan if silver trades lower first? Do I have a second tranche? A third? Or am I going to be fully invested and emotionally trapped? Because here's what happens to all-in buyers in a falling knife. They buy. Price dips again. They feel pain. They watch their smart buy turn red. And then they become the exact panic seller they mocked, just at a worse price. Discipline beats adrenaline. Every time. Mistake number 3. treating paper price as the only price. This is where most people get deceived. They stare at one chart and assume it represents reality. But in metals, the paper market can temporarily detach from physical tightness, especially during margin events. Watch the premiums. Watch physical availability. Watch what happens in the places where metal actually changes hands. Because if paper prints $85 and physical is still clearing higher, if bars are scarce, if premiums don't fall, if out of stock stays up, then the sell-off is telling you something. The paper market is being cleaned out, not the physical market. And there's another layer here that most Western traders ignore: Asia. Shanghai is not a rumor mill. It's where physical demand is expressed with different constraints and different incentives. When the premium in a physical hub stays elevated while New York gets smashed, that's a signal, not a guarantee, a signal. Signals matter during a liquidation because they tell you where the real floor might be. And they tell you whether the crash is the whole story or just the loudest part of it. Mistake number 4. Letting weekend content hijack your brain. This weekend, your feed is going to be a psychological assault. You'll see, silver is collapsing. You'll see, this is the end. You'll see, $50 next. You'll also see the opposite. Silver to $300 Monday. People sell fear and people sell hope. Both are addictive. Both are profitable for the content machine. Neither is a plan. The weekend is dangerous because you have time. Time to stare. Time to reread. Time to imagine worst-case scenarios. Time to turn uncertainty into certainty. The false certainty of doom. And then Monday morning arrives and you act on the story you told yourself, not on the data. So do something boring and powerful. Write your rules down tonight. Not in your head, on paper, in a notes app, somewhere you will actually see. Write, what would make me add? What would make me trim? What would make me exit? What is my maximum exposure? What news would force me to update my thesis? Rules, not vibes. Because the market only feels unfair when you show up unprepared and let emotion drive the steering wheel. Mistake number 5, forgetting what silver is. Silver is not a sleepy asset. Silver is a wild animal. It rips, it dumps, it fakes you out. It has humiliated traders for centuries. That volatility is not a bug. It's the toll you pay for exposure to a metal that sits at the intersection of money, industry, geopolitics, and leverage. History is full of silver events where rule changes and liquidity shocks created violent moves. When exchanges adjust conditions, when leverage gets squeezed, when positioning gets one-sided, silver doesn't gently correct. It snaps. If you cannot emotionally tolerate a 30% move, silver will own you. It will push buttons you didn't know you had. It will make you do things you swore you'd never do. So the first real question is not, will silver go up Monday? The first question is, am I built for this asset? Now, after all the don'ts, what should you do? Step 1. Separate price from position. If you hold physical metal, you still hold the same ounces. Your coin didn't melt, your bar didn't evaporate. The number on a screen changed. That number changes every day. Step 2. Audit your exposure. How much of your total net worth is tied to silver? If you're so overweight that a drawdown threatens your life stability, that's not conviction. That's risk mismanagement. Reducing exposure to sleep at night can be rational, but it must be planned, measured, and rule-based, not a reaction to a red candle. Step 3. Use the weekend for research, not prophecy. Look at a few boring inputs. Are physical premiums compressing or staying stubborn? Are inventories visibly loosening or staying tight? Are institutions increasing longs, reducing shorts, or doing the opposite? Is the dollar strength real or just a knee-jerk move to a headline? Data doesn't guarantee outcomes, but it protects you from the most expensive mistake, acting on vibes. Step 4. Build 2 Monday plans. Plan A. Silver opens lower and continues lower. What do? Hold, add slowly, trim, do nothing? Plan B. Silver gaps higher and rips. What do? Chase, wait, take partial profits, rebalance? If you don't have both plans, you will improvise under stress. And improvisation under stress is where people donate money to the market. Now here's the part most people miss. The next 72 hours aren't just about the chart. They're about the headline stack. What could flip sentiment before Monday? Policy clarity. The headline that triggered the algorithmic move may get reframed, walked back, or clarified. The market didn't react to nuance, it reacted to keywords. If nuance returns, the dollar can retrace, and metals can breathe. Geopolitical risk. Tensions don't pause because your chart is red. Energy shocks, shipping disruptions, escalations, surprise negotiations. Any of it can shift safe haven demand fast. Metals are not just inflation trades, they're stress trades. China and export policy. When a major industrial economy treats a material as strategic, the entire supply chain starts behaving differently. Restrictions, approvals, quotas, friendly buyer priorities. These things don't show up on your candle chart until after they already matter. And one more, positioning. In a liquidation, the people who were forced out are gone. That changes the map. It changes who is left holding risk. It changes how far a bounce can run if selling pressure is exhausted. That's why Monday's open can be violent in either direction. Not because silver is random, but because a liquidation resets the playing field. Now let me give you the single most important principle for the next 72 hours. Don't make permanent decisions based on temporary mechanics. Margin hikes are mechanics. Algorithmic headline selling is mechanics. Forced liquidation is mechanics. Mechanics can crush price short-term, even while fundamentals remain intact. Fundamentals are the slow engine: industrial demand, monetary demand, supply constraints, mining timelines, geopolitical stress, currency trends. If you confuse mechanics with fundamentals, you will sell the bottom and buy the top over and over again. You will call it bad luck. It isn't. It's misreading the game. So what's the play? If you're underallocated and you have a long time horizon, you can build a position slowly, tranches, not hero buys. If you're overallocated, you can rebalance with rules, not fear. If you're paper leveraged, you can reduce leverage, because leverage is what turns a normal move into a forced exit. And if you're simply overwhelmed, the best move might be to do nothing this weekend. Doing nothing is a position, a disciplined position. Let's talk about the emotional trap you're about to face. When price drops fast, your brain screams, "Protect me." That's ancient wiring. It kept humans alive. In markets, it gets you hunted. When price bounces fast, your brain screams, "Don't miss it." That's the other ancient wiring, tribe psychology. In markets, it gets you chasing. Your job is to build a small system that overrides both instincts. Write the plan, respect the plan. Adjust the plan only for facts, not feelings. And here's a practical exercise for you right now. Open your Notes app. Write one sentence. If silver trades blank, I will blank. Fill in two prices, one lower, one higher, and one action. Hold, add small, trim small, exit, whatever matches your risk tolerance. That single note will save you more money than 90% of the content you will consume this weekend. Now, I promised you I'd tell you the one thing you should not do in the next 72 hours. Here it is. Do not let a weekend narrative force you into a Monday morning market order. Monday morning market orders are where retail gets slaughtered. Spreads widen, volatility spikes, liquidity thins for moments, price jumps, your execution gets abused, and you'll think, wow, the market is rigged. It isn't rigged in that moment. It's simply doing what fast markets do, punishing urgency. If you must act Monday, act with structure, limits, tranches, patience, not a panic button. Now, quick engagement check. I want you to answer this honestly in the comments. Did you buy silver closer to $122, or are you still green even after this drop? And second question, are you holding physical, paper, or a mix? Those two answers determine what smart looks like for you. Because there isn't one perfect move for everyone. There is only the right move for your exposure, your timeline, and your temperament. And yes, I will be here when the market opens. When Monday hits, we'll read the open, we'll watch whether key levels hold, we'll compare paper price to physical signals, and we'll see whether this was a liquidation low or the start of a deeper reset. So if you want that update without the noise, make sure you're subscribed and notifications are on. The first hour of Monday is where most people make their worst decision of the month. I want you informed, not reactive. Let me close by compressing this into a checklist you can remember when your stomach is doing flips. Do not panic sell into forced weakness. Do not go all in into a falling knife. Do not ignore physical signals and overseas premiums. Do not binge weekend fear content until your brain melts. Do not forget silver's nature. Volatility is the admission fee. Instead, Breathe. Audit exposure. Research quietly. Write 2 plans. Execute with structure if you act at all. The market will do what it does. Your edge is your response. Because in a liquidation event, the greatest transfer of wealth doesn't happen from smart to dumb. It happens from emotional to disciplined. And the next 72 hours are the test. Hold your nerve. Hold your rules. Let the mechanics pass. Then, when the dust settles, you'll still be standing. And that's when the real opportunities show up. One more thing, because people keep asking, was this random? No. It had fingerprints. A margin hike of that size isn't a gentle tweak. It's a lever. When collateral requirements jump, the system forces the weakest hands to sell regardless of belief. That's why it feels like a trap. It is a trap for anyone running leverage without a cushion. And once that cascade starts, it feeds on itself. Selling creates lower prices. Lower prices trigger more calls create more selling. While the public stared at red candles, positioning was shifting. Reports showed major banks adding long exposure and trimming shorts. The same institutions fined in the past for metals games don't become saints, but they do know how to buy when selling is forced and liquidity is screaming. They don't need the bottom. They just need the crowd to be terrified. Now the map. Around $70 sits a zone many traders treat as a line in the sand. Break it, and deeper mean reversion toward the mid-50s becomes possible. Hold it, and a snapback can be violent. That's why all-in moves are so dangerous. You're betting on one path in a 2-path market. And keep watching the physical tells. If paper prints ugly numbers but premiums refuse to collapse, if bars stay tight, if overseas hubs keep paying up, that's the quiet signal that the paper move is a mechanical flush, not a real demand collapse. The real world doesn't stop using silver because a futures contract got margin called. Zoom out further. Silver has been running a structural deficit for years, demand outpacing new supply. And a 2-day liquidation doesn't magically refill mines, rebuild inventories, or erase industrial consumption. That's why the next 72 hours matter. Not because you can predict Monday, but because you can avoid doing something irreversible while the market is doing something temporary.